Assalamualaikum warahmatullahi wabarakatuh. My name is Alif, and this is my fellow members, Azrai, Yusuf, Ifan, and Shahir. Today, we will be presenting a financial position and performance of the Malaysian property sector company. To start, it is important to understand that the property sector is a key contributor to Malaysian economic growth. It drives the nation forward through urban development, infrastructure expansion, and massive employment creation. Within this landscape, public listed property developer play the lead role in shaping the residential and commercial space we see today. However, this industry is highly dynamic, is constantly influenced by shifting economic condition, market demand, interest rate, and construction costs. Because of this variable, performing deep dive financial analysis is essential to understand which company are truly resilient. Hello, Assalamualaikum warahmatullahi wabarakatuh. My name is Alif. Today, I'm going to evaluate the financial health of Malaysia and top property developer by focusing on a critical metric, liquidity. Specifically, we will examine the current ratio, a key indicator of a company ability to cover its short-term obligation with its short-term asset. By comparing these industry leaders, we can gain insight into their operational stability and financial resilience in current market. So, first company, which is EcoWorld Development Group. Let me examine EcoWorld. Their liquidity position has steadily strengthened over the last 3 years. The current ratio increased significantly from 1.14 times in 2022 to 1.63 times in 2024. This upward trajectory suggests a deliberate and successful effort to bolster their working capital and reduce short-term financial risk. Moving into the next company, which is Simdabi Property. They continue maintain solid by sufficient short-term liquidity profile by ensuring their current ratio consistently exceeds to one-to-one benchmark. They remain a safe position to meet immediate debts. As of 2024, their ratio was recorded at a healthy 1.42 times. Next is UA Development, a company known for its remarkably strong and some might say conservative liquidity position. They demonstrate ratio far above industry average, reaching 8.05 times in 2022 and maintaining a very high level of 7.44 times by 2024. This indicates a massive cash cushion and minimal reliance on short-term debt. Now, we look at another company which is SP Setia. Their liquidity has also shown a positive upward trend. Their current ratio improved from 1.48 times in 2022 to 1.80 times in 2024. This steady improvement reflects better asset management and more robust balance sheet as they navigate their ongoing project. Finally, our last company, which is UEM Sunrise. Their story is one of a significant turnaround. In 2022, the company faced liquidity pressure as current assets were insufficient to cover liabilities. However, over the past 3 years, their profile has improved consistently, and by 2024, they successfully moved from a period of strain to a healthy, stable liquidity level. To conclude, five companies that I have been explaining to you, the Malaysian property sector is showing a broad trend of liquidity recovery and stabilization, while UAE development remains the outlier with an exceptionally high cash to debt ratio. We see encouraging growth in EcoWorld and SP Setia. Most importantly, The recovery of UAM Sunrise signifies a healthier environment for the industry as a whole. Across the board, these developers are now better positioned to handle market volatility than they were 2 years ago. To conclude, five companies that I have been explaining to you, the Malaysian property sector is showing a broad trend of liquidity recovery and stabilization, while UAE development remains the outlier with an exceptionally high cash to debt ratio. We see encouraging growth in EcoWorld and SP Setia. Most importantly, the recovery of UAM Sunrise signifies a healthier environment for the industry as a whole. Across the board, these developers are now better positioned to handle market volatility than they were 2 years ago. Hello, it's me again, Alif. Today, we are diving into comparative liquidity analysis of five key players in Malaysia property sector. We will specifically focus on the quick ratio, a stringent measure of companies' ability to meet each short-term obligation without relying on the sales of inventory. This metric gives us a clear picture of financial resilience in capital-intensive industry. Now, let's begin with EcoWorld. Their liquidity position has shown a steady and healthy upward trajectory. In 2022, the quick ratio sat at 0.74, but by 2024, it reached the 1.00 benchmark. This signifies that EcoWorld now holds exactly enough highly liquid assets to cover its current liability, reflecting disciplined fiscal management. Now we're moving to a next property company in Malaysia, which is Sim Darby Property. While they boast a significantly higher quick ratio of 4.53 times in 2024, we must look closer. Despite the strong number, the trend indicates that a sizable portion of asset remains tied up in inventories. This reminds us that while liquidity is high, the company still relies heavily on property sales for continued cash generation, a standard yet vital characteristic of this country industry. Furthermore, the UAE development present a remarkably robust profile. Their quick ratio remains strong at 4.53 times in 2024. Unlike many peers, UAE consistently maintain enough liquidity asset to cover liabilities several times over. This places them in an exceptionally low risk financial position, providing a massive buffer against market volatility. Now we're going next company, which is SP Setia. SP Setia has undergone positive transformation. In 2022, they faced a constrained liquidity position with a ratio of 0.87. However, by 2024, they improved this to 1.03. This shift is significant. It represents a strategic move away from relying on inventory to meet short-term debts, highlighting much improved cash and liquidity asset management. Finally, the last company, which is UEM Sunrise. UEM Sunrise followed a similar steady upward trend, rising from below 1.0 in 2022 to consistently exceeding 1.0 in 2023 and 2024. This improvement in their liquidity asset position has bolstered their short-term financial stability and, crucially, enhanced their day-to-day working capital management. In summary, we are seeing a sector-wide trend towards strengthening balance sheets, while UAE development and Singapore property leads with the highest liquidity buffers. EcoWorlds, SPCT, and UAM Sunrise have all successfully crossed the critical 1.0 threshold since 2022. This collective improvement suggests that these developers are now better positioned to navigate economic shift and fund future projects with greater financial security. Thank you very much.
Assalamualaikum, my name is Muhammad Azraif. I'm gonna present about the debt to ratio and also time interest earned. This slide shows the debt to equity ratio of selected property companies from 2022 to 2024. The debt to equity ratio measures the proportion of debt used in financing a company relative to shareholder equity. A lower ratio indicates lower financial risk, while a higher ratio suggests greater reliance on debt. EcoWorld showed a slight decline from 0.87 in 2022 to 0.82 in 2024, indicating a gradual reduction in leverage. SMW remained relatively stable throughout the 3 years, suggesting a well-managed and balanced capital structure. UOA records a significant decrease in its debt to equity ratio, reaching 0.02 in 2024. This indicates very low reliance on debt, which reduces financial risk but may also limit growth opportunities. Setia demonstrates a continuous decline in its ratio, reflecting effective debt reduction and improving financial stability. In contrast, UEM showed a sharp increase to 0.83 in 2024, indicating higher dependence on debt financing and increased financial risk. In conclusion, UOA has the lowest financial risk. SMW and Setia maintain moderate leverage, while EcoWorld and UEM are more highly leveraged in 2024. This slide shows the time interest earned ratio of selected companies from 2022 to 2024. The time interest earned ratio measures a company's ability to meet its interest expense from operating profit. A higher ratio indicates a stronger capacity to service interest obligation and lower financial risks. EcoWorld recorded a slight decline from 2022 to 2023, followed by a significant improvement to 4.5 in 2024. This indicates an improved ability to cover interest expenses in the most recent year. SMW consistently maintained a high time interest earned ratio, peaking at 7.74 in 2023 and remaining strong at 6.42 in 2024. This reflects strong operating performance and low risk of interest payment difficulties. UOA showed a sharp increase in 2024 to 18.74. This suggests an exceptionally strong interest coverage position, possibly due to high earnings or lower interest costs. Setia experienced a decline in 2023 but recovers in 2024, indicating improving capacity to meet interest obligations. UEM shows a steady upward trend over the 3 years, reflecting gradual strengthening in its interest coverage. In conclusions, all companies demonstrate adequate time interest earned ratio in 2024. UOA and SMW show very strong ability to meet interest expenses, while EcoWorld, Setia, and UEM also showing improving trends.
For this section, I will be presenting the activity ratio, which are used to evaluate the operational efficiency of companies, particularly in terms of receivable management and asset utilization. This analysis covers 5 property development companies, namely EcoWorld Development Group Berhad, Slum Derby Property Berhad, UOA Development Berhad, SP Setia Berhad, and UEM Sunrise Berhad over the period from 2022 to 2024. The two key ratios analyzed are average collection period and fixed asset turnover. First, average collection period measures the average number of days a company takes to collect payment from its customer. A shorter collection period generally indicated better cash flow management. For EcoWorld, the average collection period was approximately 82 days in 2022, increased to 170 days in 2023, and then improved to 102 days in 2024. This indicated that while receivable collection took longer in 2023, there was a noticeable improvement in 2024. Some Derby property recorded a relatively stable average collection period, ranging between 90 to 95 days throughout the 3 years period. This reflects consistent and controlled receivable management. For UOA Development Berhad, the average collection period showed the most consistent improvement among the companies. It decreased from 72 days in 2022 to 66 days in 2023, and further to 51 days in 2024, indicating highly efficient receivable management and improving cash flow. SP City Berhad recorded the longest collection period at around 117 days in 2022, increasing to 121 days in 2023, before improving to 107 days in 2024. Although there was some improvement, the collection period remains relatively high compared to its peers. For UEM Sunrise Berhad, the average collection period remained high at approximately 145 days in both 2022 and 2023, but improved significantly to 79 days in 2024, indicating better efficiency in receivable collection. Next, fixed asset turnover measures how efficiently a company uses its fixed asset to generate revenue. This ratio particularly important in the property development industry, which is capital intensive. EcoWorld showed a gradual improvement in fixed asset turnover, increasing from approximately 0.13 times in 2022 to 0.15 times in 2023 and 0.18 times in 2024, indicating more effective utilization of fixed asset. Some Derby property recorded a stable fixed asset turnover, ranging from 0.12 to 0.14 times, reflecting consistent asset utilization in its large-scale operation. UOA Development Berhad recorded a relatively low fixed asset turnover. However, it showed a consistent upward trend, increasing from 0.065 times in 2022 to 0.077 times in 2023 and 0.099 times in 2024. SP City Berhad showed a significant improvement in 2024, with fixed asset turnover increasing sharply to 1.92 times, indicating a strong improvement in revenue generation from its fixed asset. For UEM Sunrise Berhad, fixed asset turnover declined slightly from 3.62 times in 2022 to 3.27 times in 2023, before recovering to 3.35 times in 2024, suggesting an improvement in operation efficiently. Overall, UOA Development Berhad demonstrated the most consistent improvement in operational efficiency, particularly in receivable management. EcoWorld and some Derby property maintained moderated and stable performance, reflecting mature operational structure. Although the SP Setia Berhad and UEM Sunrise Berhad experienced weaker efficiency earlier in the period, the improvement recorded in 2024 suggests a potential recovery in operational performance. The activity ratio analyzed show that each company has different levels of operational efficiency. However, most companies demonstrate an overall improvement from 2022 to 2024, particularly in receivable management and asset utilization. This improvement supports strong cash flow management and contributes positively to long-term financial performance.
So next I will be presenting the profitability analysis of 5 property companies, which is EcoWorld Development Group Berhad, Samdari Property Berhad, UOA Development Berhad, SP Setia Berhad, and UEM Sunrise Berhad. Starting with EcoWorld Development Group Berhad, the company shows a strong upward trend in profitability over 3 years. In 2022, profitability was moderate as projects were still developing. In 2023, profit margin improved due to better cost management. In 2024, profitability increased significantly with operating profit margin nearly doubling compared to 2022. Return on equity also improved across the 3 years, showing that EcoWorld became more effective in generating returns for shareholders. Overall, EcoWorld demonstrated the most noticeable improvement in profitability among all companies. So for Sunderby Property Berhad, profitability shows a steady and stable trend, which is in 2022, operating profit margin and ROE were at a reasonable level. In 2023, both ratio improved slightly, reflecting better operational efficiency. In 2024, profitability continued to strengthen but without drastic change. This indicates that Samdari Property focuses on consistent and sustainable profitability rather than rapid growth. And next, UOA Development Berhad displays high but stable profitability throughout the 3 years. In 2022, the company already recorded a strong operating profit margin. In 2023, profitability remained high with minimal change. And in 2024, operating margin declined slightly but still remained at a healthy level. So return on equity stay around 4 to 5% for all 3 years, indicating consistent returns. UOA shows supported by its low debt and rental income. For SP Setia Berhad, profitability shows a clear improving trend. In 2022, operating profit margin was relatively low. In 2023, profitability increased due to improved efficiency. In 2024, operating profit margin rose significantly to around 21%. However, ROE remains low despite improvement due to the company's large equity base. This shows strong operational profitability, but shareholder returns take longer to grow. Lastly, UEM Sunrise Berhad shows mixed profitability performance. In 2022, profitability was weak with low operating margin and ROE, but in 2023, operating profit margin improved significantly. In 2024, profitability declined, again indicating higher costs or efficiency issues. ROE improved slightly but remained low overall. This suggests that UEM Sunrise profitability is less stable compared to other companies. So best improvement from 2022 to 2024 is EcoWorld Development Group Berhad, but most stable profitability is UOA Development Berhad. And highest operating profit margin in 2024 is SP Setia Berhad. And consistent but moderate performance, Samdari Property Berhad. And most volatile profitability is UEM Sunrise Berhad. So in conclusion, SP Setia Berhad is the best company in terms of profitability. This is because it recorded the highest operating profit margin in 2024 and show a consistent improvement from 2022 to 2024, indicating strong cost control and operational efficiency compared to the other companies. Thank you.
Ecoworld show a consistent and significant decline in dividend payout over the 3 years. This suggests the company is gradually reducing dividend dependent and retaining more earnings, likely to support future development, project and manage financial risks amid a challenging property market. For Scientific Property, maintain a stable and moderate payout ratio with a slight increase over time. This reflects a balanced dividend policy where dividends are paid consistent without placing pressure on earnings sustainability. For SP30 show a gradually increase in dividend payout ratio, although the ratio remains relatively low. The upward trend suggests improving profitability or stronger cash flow, allowing the company to reward shareholders more while still retaining earnings. For UEM Sunrise, record no dividend payout through the period. This indicated a strategy focused on earning retention, likely due to the investment need, financial restructure, or weaker profitability during these years. In conclusion, the dividend payout ratio indicates the Malaysian property company adopt dual dividend strategy. UOA Development stand out for dividend stability, while EcoWorld and SP30 adjust payout in line with financial condition. UEM Sunrise Zero payout highlight a focus on internal strategies rather than shareholder distribution. Overall, the trend suggests caution dividend to management in response to market uncertainty. Next is price earning ratio. First, UEM Sunrise record the highest and fastest growing PER among the companies. The sharp increase from 2022 to 2023 suggests strong investor optimism, possible driving by expectation of future earnings, recovery or strategy development. However, such a higher PER also indicate that the stock may be expensive value related to current earnings. Next is SP30 show a steady increase in PER over the 3 years. This upward trend reflects improving market confidence, suggesting investors expect better future performance and earning growth compared to earlier year. Next is Scientific Property. PER rise gradually indicating moderate but consistent growth expectation. The increase suggests improving earning outlook and a more positive market perception, while still remaining lower than UEM, Sunrise and SP30. EcoWorld record the lower PER across all 3 years, although the ratio increased steadily. This indicated the company may be relatively undervalued with improving investor confidence, but still conservative market expectation compared to peers. Next, based on the chart, UOA development PER not reflected possible due to negative earnings, very low valuation or exclusion from the dataset. This limits direct comparison with other companies. Overall, the rising price earning ratio suggesting improving market confidence in Malaysian property developer. UEM Sunrise command the highest valuation due to strong growth expectation, while EcoWorld appear undervalued despite gradual improvement. Overall, the trend reflects positive investor sentiment and anticipate earning recovery across the sector. In conclusion, financial ratio analysis from 2022 to 2024, the selected property companies show varying level of financial strength and risk. UOA Development Berhad demonstrated the strongest financial stability with the higher liquidity and very low leverage. EcoWorld Development Group Berhad show significant improvement in profitability and debt management. indicating a strong turnaround. Sign-Nabi Property Berhad maintains stable and prudent performance, while SP Sacha Berhad record gradual improvement despite modest return. UEM Sunrise Berhad present higher financial risk due to increased leverage, although market confidence remains positive. Overall, the analysis confirmed that financial performance in the property sector depends heavily on liquidity management, leverage control, and strategy positioning. That's all. Thank you.